Borrowing money is one thing, but borrowing over $2 billion just to pay someone else's breakup fee with Netflix? That is a serious plot twist. Welcome to Earnings Unscripted. It is May 4th, 2026, and today we are looking at the studio and streaming giant Paramount Skydance. Ticker is PSKY, and we are breaking down their first quarter of 2026. Miro, the numbers here are, they're a little whiplash-inducing.
Yeah, whiplash is the right word. They're basically shrinking the top line to fix the bottom line. Revenue came in at $7.35 billion, so that is down, well, nearly 10% sequentially from Q4. But then you look at operating income, and it swung to a positive $616 million. I mean, they were running a $300 million loss just 3 months ago. EPS is suddenly positive 15 cents.
Which is honestly a masterclass in finding loose change in the couch cushions. Oh, quick reminder, we are just sharing personal opinions here, so definitely not financial advice. But you have to admit, pulling off a massive profit swing in one quarter is wild. How did the tape handle the shock?
Pretty cautiously. The stock had an ugly quarter overall, drifting down to close March around $8.90. But the earnings day reaction was actually fascinating. Right after the regular close at 11:13, the stock spiked hard in extended hours, hitting 11.87.
Oh, wow. So instant validation.
Actually, no. The earnings call started right after that peak. People started looking at the new debt load, and the stock faded right back down. It ended up with just a modest gain, up about 1.5% from the previous close.
Yeah, that makes sense. Because you see a headline saying Paramount Plus dropped over 1 million subscribers, and the instinct is to panic. But management actually wanted those people gone. They literally called them uneconomic hard bundle subs.
Exactly. Those users were generating less than $1 in average revenue. It is just empty volume. Cutting them loose actually pushed their core ARPU, the average revenue per user, up 14%.
That is real money. And speaking of the people who actually pay, did you catch the note about UFC? David Ellison said their new UFC streamers are, on average, 15 years younger than the typical Paramount Plus demographic. And the best part is they come for the live fights and then stick around to binge South Park.
I mean, that is the cross-pollination of the century. You watch mixed martial arts and then immediately pivot to Cartman.
It is a completely new audience for them. But okay, back to that crazy Netflix debt thing for a second. The elephant in the room here is the Warner Brothers Discovery merger. They pulled $2.15 billion from their revolving credit line just to pay WBD's termination fee to Netflix. Total debt jumped over $15.4 billion.
Yeah, they basically threw cash at the wall to clear the legal barriers for the combination. Leveraging up your own balance sheet to bail out your acquisition target is a huge show of confidence. Or it's a massive gamble. But to pay for that gamble, they're slicing costs in the tech stack, which is where things actually get really interesting.
Right, the AI coding stuff. All right, let's get into the details.
Yeah, the AI piece is, well, it is where that massive $3 billion efficiency target actually stops being corporate fluff and becomes structural. They said 80% of their engineering organization is now using code-assisted technology.
Wait, 80%? That is not a pilot program. That is basically the entire floor.
Right. It is the new baseline. And Andrew Gordon said it on the call. This is cutting software approval times by more than half, which, if you know anything about development bottlenecks, speeding up by 50% is an absurd acceleration.
It almost sounds too perfect. Like they're trying to convince Wall Street the tech can outrun the merger chaos.
That's exactly what they're doing. And they really have to. Look at what they're attempting this summer alone. They are unifying the backends for Pluto, BET+, and the main Paramount app onto one single tech stack. Plus, they're rolling out Oracle Fusion.
Which is notoriously painful. ERP integrations are... they ruin quarters all the time. Just look at recent history.
They ruin years. It is basically corporate entropy. You're trying to rebuild the entire operational foundation of the house, and then you're planning to drop the Warner Brothers Discovery asset right on top of it.
That is a terrifying visual. I kind of love it.
It is massive execution risk. But if those AI tools keep the code failure rates low during the migration, they might actually pull it off.
Okay, but let me reframe this for a second, because If operations are getting so incredibly lean right now, I'm trying to square that with their guidance. They're projecting roughly, what was it, $800 million in transformation costs coming up?
Yes, that's the reality check hiding in the fine print. Free cash flow this quarter was $96 million. Pretty clean, almost flat sequentially. But they're hiding a giant restructuring bill just over the horizon. Severance, retiring redundant software, prep work for WBD.
Sorry, I just realized, so Q2 is going to take a huge cash hit to actually pay for these future synergies.
Exactly. Cash flow is going to get gutted next quarter. They literally warned it will take several $100 million in cash out. The market is just supposed to look the other way and trust the long game. And on top of that, Dennis and Neely flat out warned that margins are going to shrink in the back half of the year.
Because the content slate kicks back in.
Right. He literally said, we expect some margin pressure in the back half as the slate launches in Q3 and Q4. They honestly did not spend much on content this quarter, so that huge EBITDA pop we talked about, a good chunk of that is just delayed spending.
That makes sense. It's not permanent leverage. It's more or less a quiet period before the storm. Once you start marketing massive releases and shooting shows again, those costs just flood right back into the income statement.
The financial engine is running at redline, essentially. They have a very narrow window to get these tech efficiencies fully locked in before the content costs ramp back up and the WBD deal closes.
Which really puts the pressure on that Q3 timeline. They're balancing debt, massive integrations, and a whole new product cycle all at once. So where does this actually leave them heading into next quarter?
Well, it leaves them in a very weird optical position for Q2. Management is forecasting revenue right around 6.8 to nearly 7 billion, but they expect headline subscriber growth to essentially look completely flat.
Oh, right, because they are dropping another 2 million of those international hard bundle users, the uneconomic ones.
Exactly. They are basically trading empty volume for actual paying customers. And Dennis Sinelli framed this on the call. He said growth for the rest of the year will be driven by healthy underlying subscriber adds as the content slate fills in. So their whole financial narrative is, well, heavily back half weighted.
Which is always a little nerve-wracking from an investor standpoint. You're essentially telling Wall Street, hey, trust us, the real money shows up in September. Just please ignore the giant restructuring bill coming due before then.
Right. It requires a perfect landing. They reaffirmed their optimistic $30 billion full-year revenue target. But to actually hit that, the Oracle rollout has to work without breaking the company. The Warner Brothers deal needs to close seamlessly by Q3, and those new AI coding tools have to actually hold the infrastructure together while they do it.
Yeah, it really all comes down to pure execution now. The strategy actually makes a lot of sense on paper, but transforming a legacy studio into a lean tech platform is historically very difficult.
Or as I prefer to look at it, a fascinating stress test for a $15 billion debt load.
Of course you look at it that way. Well, we will see if their new code assist can write a happy ending for them later this year. Let's wrap it up there for today. Thanks for hanging out and geeking out with us.
Catch you on the next call.
If you want these earnings drops to just automatically show up for you, go ahead and follow the podcast. And just a quick aside, this whole show is actually AI generated, which is how we managed to compress a massive pile of financial filings into a short chat you can easily listen to on your commute. If there is a specific ticker you want us to dig into next, just shoot an email to earningsunscripted@datamadness.ca or grab the X link right in the show notes.
See you next time.